Okay, so the week of April 13 to 17 of April 2026, right, was a historical turning point for the global market. A massive relief rally, right, was actually fueled by the cooling of the 2026 Iran-US conflict and the reopening of the Strait of Hormuz. So, which allow investors to shift their focus back to the secular AI growth story. So for the market summary for the week of 13 to 17 April 2026, the S&P 500 dominated headlines by crossing the 7,100 mark for the first time, ending the week with a record-breaking momentum. On the geopolitical relief title, the primary catalyst was the formal implementation of a two-week ceasefire between the US and the Iran mediated by Pakistan. So the reopening of the Strait of Hormuz on April 17 instantly reduced the war premium that had been choking global trade. So indices performance, the S&P 500 gained roughly 3.4% on the week. The Nasdaq outpaced broader market as mega cap tech stocks surged on the news that the semiconductor giant like ASML raised its 2026 forecast, signaling that the AI infrastructure build-out remain unfazed by the regional instability. So on the oil and inflation title, while crude prices ease from the conflict peak, right, they remain elevated, but actually hold near the $95 to $100 barrel per barrel. Interestingly, investor look through a hot March CPI report, which is at 3.8% headline, because core inflation remains stable at 2.7%. So suggesting the spike was almost entirely energy driven and temporary. So for the last title will be the earnings kickoff. So early Q1's report from the major banks like Morgan Stanley, Bank of America showed resilience, while the market began positioning for big tech earnings later in the month. Okay, now coming to the market outlook for this week, 20th to 24th of April 2026, right? Okay, entering the new week, right? The market is in a risk-on phase, but the rally faces a test of sustainability as it moves us into the overbought territory. So the AI earnings season intensify. The focus shift from a will there be peace to how much the AI make. So Tesla earning coming on the 22nd of April. This will be the first major test of whether growth-oriented sentiment can withstand the hardware margin pressure. Okay, the next will be the big tech preview with Microsoft, Alphabet, and Meta reporting the following week on April 29. Any pre-earnings, right, for running could push the S&P 500 towards the 7,200 level. So for the next one will be the technical resistance and the pain trade. So on the upside, technical analysts are watching the 7,205, which is the 127.2% Fibonacci extension. So if the S&P 500 holds above the 7,100, right, the pain trade, investors forced to buy back in after sitting out during the conflict, could drive the index higher. So on the downside, so initial support sits at 7,000 to 7,013. So a failure to hold the 7,100 might lead to a healthy consolidation as traders lock in profit from the 10 days relief surge. So on the macro and the geopolitical monitoring, so ceasefire fragility while the Strait of Hormuz is open, any reports of violations in Lebanon or secondary proxy strikes, right, could reignite the oil volatility. So Fed commentary, watch for a flurry of Fed speakers, including the New York Fed President John Williams. If they signal that the higher for longer is back on the table due to the energy-driven headline inflation spike, the rally could stall. So the consensus for this week, right, is cautiously bullish. The market has the wind at its back from the ceasefire, but with the S&P 500 at all-time high, the margin for error during earnings season has become razor thin. Appreciate a like and share for this video if you find the video useful. Now coming to the macro snapshot. Okay, leading to into the week of 20th to 24th of April 2026, the macro landscape is shifting from a state of geopolitical paralysis to one of the hawkish optimism. The relief rally has fundamentally altered the volatility regime, and a new tension is emerging between the surging equity prices and a more restrictive interest rate outlook. So on the risk appetite, okay, we are looking at resounding but fragmented. So the risk appetite actually transitioned from a risk off to a selective risk on. So institutional shift, the S&P 500 global risk appetite index actually shrunk from a negative 16% in March to positive 7% in April. However, this is not a buy everything market. On the sector divergent, investors are aggressively rotating into big tech for the AI growth and the financial on the higher rates and resilient credit, while shunting the consumer-focused equity and real estate due to the persistent inflation and borrowing costs. So the Hormuz effect, while the ceasefire is fragile, the physical reopening of the strait on the April 17th actually act as a massive psychological green light for the pain trade short covering. Okay, next coming to the rate direction, we're looking at the hawkish hole. So despite the relief rally in stock, right, the bond market is signaling a higher for longer 2.0. So the fact stand, the FOMC actually held the federal funds rate at 3.5% to 3.75%. However, Fed official notably from the New York and the St. Louis Fed, right, are highlighting that energy-driven headline inflation approaching 3% again is crowding the path to rate cuts. So on the yield curve, US Treasury yield has been rising as bond prices fall. So investors are pricing out the possibility of summer rate cuts as the economy remain too hot and the energy cost, even if easing, right, still pose a pass-through risk to core PCE. So on the bottom line, expect the rate, right, to remain plateau at the current level through at least Q3 2026, with the next move, right, more likely to be hawkish skip rather than a pivot. So volatility regime side, right, we are looking at from crisis spike to mean reversion. So we have moved out of the high stress regime of the late February and March into a mean reverting low volume regime. So the VIX collapsed. So the VIX saw a volatility vacuum collapsing over 20% recently as geopolitical theories, the total regional war were depriced. So the IV versus the RV, right? The implied volatility IV is currently falling faster than the realized volatility RV. So this suggests a window where the selling premium, example, your iron condor or the bull put spread, is becoming attractive again as the market expect a period of consolidation following the 7,100 breach. So for the tail risk, the regime is actually currently gamma positive, meaning that market makers are likely hedging in a way that dampens the daily swings. But the fragility of the ceasefire, right, means a volatility jump remains the primary risk of for the upcoming week. So summary, we are actually entering a Goldilocks-like environment where the removal of war risk is actually offsetting the reality of a high interest rate. So the market is actually betting that AI-driven productivity gains can outrun the cost of capital. So for the technical landscape for the week of 20th to 24th of April 2026, right, is defined by an expansion versus the exhaustion dynamic. So after the S&P 500 cleared the 7,100 psychological barrel, the market is actually structurally in a blue sky breakout. So, but the short-term oscillator like the RSI, right, are signaling that the rally is physically overstretched. So for the S&P 500 weekly outlook, the trend continuation, we are looking at above the 7,200 path. So the trend remains aggressively bullish on the all major time frame. The move above the 7,000 has shifted the previous resistance into a fortress support level. So for continuation trigger a daily close above the 7,148, which is the current all-time high. If the market hold this right, the next Fibonacci extension target will be 7,205. So for the driver, as long as the Strait of Hormuz remain open and oil stay below 100, so the peace dividend would likely continue to fuel a rotation out of cash and back into equities. On the pullback risk level, so with the daily RSI hovering near the 72 level, a mean reversion to test the recent breakout points is likely. So for level 1, the minor tip, so we're looking at 7,065. This is the immediate support zone where buyers recently stepped in during the mid-April consolidation. For level 2, the structural test, so we're looking at 7,000 to 7,015. A pullback to the 7,000 would be considered a healthy retest of the psychological breakout line. If the index stay above 7,000, the bull trend is technically intact. On the risk warning, so a failure to hold the 6,950 right would signal a false breakout and could trigger a rapid devaluation back towards the 6,750. So we're looking at the pullback risk right at around 6,750. Now coming to the weekly outlook for Nasdaq. So the Nasdaq critical level. So the Nasdaq 100 right has just ended its longest winning streak since 2029, 12 consecutive days in actual fact. So it is the most crowded trade in the market right now. So we're looking at the strength above the 26,500 level. So the definition is that this is the current ceiling of strength. So for the analysis, right, if the NDX right could can actually stabilize and trade consistently above the 26,500, it confirmed that the investors are willing to pay the extension multiples for the AI growth regardless of high interest rate. So the target, a successful consolidation above the 26,500 opens the door to the 77,200 mark by early May. So for the failure below the 26,180, so this definition will be the line in the sand for the short-term trend. Analysis-wise will be 26,182 was the previous all-time high record. In a strong bull market, right, all resistance should become a new support. So for the consequences, the daily close above the 26,180 would suggest the 12-day stretch was an exhaustion gap. So this would likely lead to a deeper correction towards the 50 days moving average, currently near the 24,740. So this represents a potential 5 to 6% drawdown from the current levels. So on the volatility note, right, with the VIX normalizing near 18, so we do expect a choppier price action than last week. So the market is actually transitioning from a vertical surge to a broadening top or a high level base. Staying nimble at this level is actually essential. Based on the current technical setup and momentum leading into the week of April 20th to 24th of 2026, right? Here are the critical level for the 4 stocks that is currently in my watch list. So the first stock that we'll be looking at this week will be the United Health Group, UNH. So UNH has recently broken out of a medium-term falling channel, suggesting a structural shift from bearish to the horizontal bullish. So bullish buyers, we are looking at $325. A sustained hold above this level, right, confirms the breakout from the falling trend. With earnings expected on the 21st of April, the buyers remains positive as long as it stays above the recent ceiling turn floor. So in validation, we're looking at below $300. This is a major psychological and technical support zone. A daily close above the $300, right, would signal that the recent breakout was a bull trap and reinstate the falling trend. Now we're coming to the second stock for this week, which is Boeing, BA. So Boeing is currently trading within a rising trend channel, but is approaching a significant technical wall. So for the bullish buyers, right, we're looking at above $225. This stock is currently testing the resistance near the $224. A decisive break and hold above the $225, right, will signal a continuation towards the next major target at $261. So for the invalidation, we're looking at below $191. BA is in a large rectangle formation, while short-term pullbacks are expected. A failure to hold the 191 support level would invalidate the current rising trend and would suggest a deeper structural decline. So now coming to the third stock of this week, we'll be looking at Advanced Micro Devices (AMD). So AMD is exhibiting an extreme bullish momentum and is technically overbought, following its push right towards the all-time highs. So for the bullish buyers, right, we're looking at above of $274. As long as AMD stay above this recent pivot point, right, the path of least resistance is towards the 290 to $300 range. The blue sky breakout is active here. So the invalidation, we are looking at below $255. This aligns with the second level of support and the recent breakout base. So falling below $255 will suggest that the AI led rally has exhausted itself for now. So likely leading to a retest of the $230 zone. Now coming to the fourth stock of this week, with Intel INTC. So Intel has seen a massive surge up over 40% in the last 22 days. So this leading to an overbought RSI above the 70. So the on the bullish buyers, right, we're looking at above $55. Intel has cleared all the immediate resistance, holding above $55, right, maintain the parabolic momentum buyers. If it's maintained this level, right, there is no ceiling in the immediate price chart. So for the invalidation, we are looking at below $54 because the move has been so vertical. The floor is tight. A drop below $54 would be a signal of a blow off top. So likely to triggering a fast correction back towards the $41 area where the 50 days moving average sits. Now coming to the summary table, what to watch for this week. Okay, for 21st of April, we have the NFIB Small Business Optimism. So expected impact, the gauge of a domestic economic health post-conflict. So on the 22nd of April, we have the Tesla Q1 earnings. This is critical for growth and then the EV sentiments as well. On the 23rd of April, we have the weekly jobless claim. This will actually have the expected impact of the labor market cooling versus the overheating check. So all week, basically still focus on the Strait of Hormuz traffic. The expected impact will be the real-time verification of the global oil flow recovery. Well, coming to the risk management framework. So do remember trade levels, not opinion, define the invalidation before entry, reduce the size during the consolidation. So now coming to the discipline and patient win. So do remember that this is only educational content only, not financial advice. This disclaimer that the analysis and the result presented does not recommend or suggest any investing, right, in the same stock. So this is purely for analysis purpose.